What if I told you that you could make $200 to $300 a day trading options with just $1,000? Sounds impossible, right? Well, stick around, because by the end of this video, you'll understand exactly how to do it, using smart strategies, risk management, and market volatility to your advantage. This is not about gambling or hoping for a lucky trade. This is about calculated moves, discipline, and understanding market behavior. Let's get started.
Welcome to the Trade Savvy Academy. For live options and equity alerts, please follow our account on X. Before we dive into strategy, let's quickly go over why options are the best tool for small accounts. Unlike stocks, where you need thousands of dollars to make significant gains, options allow you to control 100 shares of a stock with a fraction of the capital. That means higher potential returns, but also higher risk. The key? Managing that risk and playing smart. Let's break down how you can turn a $1,000 account into a consistent $200 to $300 daily profit. 1. Focus on liquid, high-volume stocks.
Your best bet is trading highly liquid stocks and ETFs like SPY, QQQ, Tesla, and Apple.
These have tight bid-ask spreads, meaning you won't lose money on bad fills.
Imagine you're looking at a call option for Apple.
The bid price is $2 and the ask price is $2.02. This means the difference between the buyer's maximum price, bid, and the seller's minimum price, ask, is just 2 cents, a very tight spread. If you buy the option at $2.02 and immediately decide to sell it, you'd only lose 2 cents per contract due to the spread. For a single contract, 100 shares, that's a $2 difference, a minimal cost. Now compare that to an option with a wide bid-ask spread, like a small cap stock or a liquid ETF. Let's say the bid is $2, but the ask is $2.50, a spread of 50 cents. If you bought at $2.50 and immediately sold at $2, you'd lose 50 cents per contract, or $50 for one contract, right off the bat.
Tight bid-ask spreads, like the 2-cent spread in the Apple example, allow you to keep more of your profits and reduce slippage. This is why trading options on highly liquid stocks and ETFs like SPY, QQQ, and Apple is essential for smaller accounts.
It ensures you're not losing money unnecessarily on execution costs, which can eat into profits quickly. Look for options contracts with at least 5,000 plus open interest and a delta of 0.30 to 0.50 for a balance of affordability and responsiveness. High open interest ensures there is enough market participation to quickly enter and exit trades. Closer expiry dates on liquid stocks or ETFs usually have higher open interest. So, when picking an option, focus on the open interest that really stands out compared to the nearby strike prices. This ensures you're trading in the most active and liquid contracts. On a side note, Delta measures how much an option's price is expected to move for every $1 change in the price of the underlying security or index.
2. How to trade gamma scalping and momentum breakout. Now, here's where the money is made. You're going to focus on volatility and momentum. This means trading options before a big move happens. The key? Predictive volatility spikes. Here's how to do it. Look for pre-market movers. Start your day by scanning for stocks that have already moved significantly before the market opens. Use scanners like Thinkorswim, TradingView, or FinViz to find stocks gapping up or down with high volume. Identify key support and resistance levels. Draw horizontal lines at recent highs and lows. If a stock is approaching these levels with rising volume, it signals a potential breakout. Analyze implied volatility, IV. Use your broker's IV scanner to see if options premiums are rising even before the stock moves. This indicates that market makers are expecting a big move soon. Look at unusual options activity, UOA. Tools like FlowAlgo or Unusual Whales show if big institutions are betting on a move before it happens. If you see large call buying at a key resistance level, it's a strong bullish signal. Confirm with technical indicators. RSI above 60 signals strong momentum. A MACD crossover above the signal line confirms bullish strength. VWAP, volume weighted average price, helps ensure you're entering at a strategic price. Watch time and sales, level 2 data, for large orders confirming institutional interest. Enter on confirmation. If you're trading a breakout, wait for the stock to break the resistance with a surge in volume. Buy at the money or slightly out of the money options expiring in 5 to 10 days for quick scalps. Keep your stop loss at 30 to 40% of premium value to control risk, exiting at target levels and making the big gains. This is where the game changes. Don't let your big winners slip through your fingers too soon. Many traders cut themselves short, leaving massive profits on the table. Instead, take a smarter approach. Take profits in increments. Close half of your position once the trade is up 50%, and then let the rest ride by trailing your stop. Here's the kicker. If you notice rising open interest in the direction of your trade, it's a strong signal that the stock may continue trending in your favor. This is where the magic happens, where traders score 500%, 1000%, or even more on their option trades. Patience and strategy are the keys to those life-changing wins. Say Tesla is set to report earnings tomorrow. The stock has been trading in a tight range, and implied volatility, IV, is rising, a clear signal that options premiums are about to skyrocket. Here's exactly how to trade it. Step 1. Open your broker's options chain and check weekly call options with a strike near the current price. Look for implied volatility around 50% or lower. Step 2. Enter the trade when Tesla consolidates near resistance with rising volume. Use the 1-hour and 4-hour timeframes to identify key resistance levels, ensuring that price action is respecting those zones. Confirm with a 5-minute chart for a precise entry point when volume spikes. Buy a call option with 5 to 10 days to expiration, ensuring you are entering with strong momentum and not into resistance rejection. Step 3. As earnings draw closer, capitalize on the strategy known as the implied volatility rush. This surge in implied volatility often occurs leading up to an earnings announcement, and Tesla is one of the most popular stocks to leverage for this approach. Step 4. Sell your position before the earnings are announced to lock in the gains from the IV increase, typically a 40 to 60% profit on the premium. Mastering this strategy takes practice, so always remember that discipline and patience are key. This works because market makers price in expected movement. By buying early and selling before the event, you profit from increasing premiums without taking unnecessary risk. Now let's look at a different approach, trading a momentum breakout. Step 1. Identify a bullish wedge pattern forming over multiple days. Step 2. Confirm with RSI and volume rising near resistance. Step 3. Enter at the money call options with 5 to 10 days expiration as price nears a breakout. Step 4. If price breaks resistance with a volume surge, options premiums jump 30 to 50% or even more. Step 5. Sell in increments to lock in profits, using a trailing stop to capture more gains.
Even the best traders don't win every trade. Here's how to limit losses and maximize profits to keep your account growing. 1. The 50-30-20 rule. Limit your risk to 50% of your account on open trades. While 50% is on the higher side for options trading, the goal of this video is to take slightly bigger risks with a smaller account to aim for higher returns. Keep 30% in cash for adjustments. Avoid allowing any losing trade to consume more than 20% of your total account balance. It's important to note that the likelihood of this occurring is relatively high when trading with a small account in pursuit of larger returns. Second, stop losses and take profit zones. Set stop losses at 30 to 40% max loss on a trade. Take profits at 50 to 100% gain, depending on momentum. Use trailing stops to secure profits on strong moves. Avoid holding through major events like FOMC meetings or earnings unless trading pre-event implied volatility spikes. The key to consistent $300 days: protecting your account so you can trade again tomorrow.
So, let's recap how to consistently make $300 a day trading options with $1,000. Trade highly liquid stocks with volume and tight spreads. Use short-term momentum and volatility strategies. Capitalize on implied volatility spikes before big moves. Manage risk with the 50-30-20 rule and stop losses. Scale up over time to grow your account. Also, you must understand not every day is a trading day. The days you feel lost or uncertain, simply walk away from the screens. Don't be a gambler. Markets were here before you were born and will continue to be here tomorrow. Always practice risk management, patience, and discipline. Now, it's your turn. Use what you've learned today, start practicing, and see the results for yourself. For live options and equity alerts, don't forget to follow me on Twitter, subscribe for more pro trading strategies, and let's get this money.